When I talk about real breakouts, I'm not talking about the kind that shout at you from every charting screen. The market has a habit of fooling the eager man. I learned early that prices don't move because you want them to. They move when the line of least resistance finally gives way. Have you ever noticed how the best moves begin quietly, almost as if no one cares? When I say that breakouts are proven by staying power, not the first push, I'm speaking from hard experience. The market loves to tempt the impatient man. A stock jumps a point above resistance, and suddenly everyone believes they've witnessed something important. But tell me, what has really changed in that first burst? One trade doesn't make a trend, and one strong bar doesn't change the balance of supply and demand. I've seen prices poke their head above a level only to sink back like a swimmer who can't handle the current. That first push is often nothing more than testing the water. The professionals are not impressed by noise. They watch to see whether the price can remain where it has no business being, at least according to the past. Can it stay there when the early buyers take profits? Can it hold when the doubters step in to sell? Staying power is the market proving its own case. It shows that demand is not just enthusiastic but persistent. That's a very different thing. Anyone can buy once. It takes real conviction for buyers to keep stepping in after the excitement fades. Have you noticed how the strongest stocks barely flinch after they break out? They don't rush. They don't panic. They simply refuse to go back. This is where the trader's temperament is tested. You must be willing to let the first move go by without you. That's not weakness. That's discipline. The market doesn't pay you for speed. It pays you for being right. Waiting to see if price holds above the old line keeps you aligned with reality instead of hope. The man who waits for staying power is not trying to outsmart the market. He is letting the market do the convincing. He risks less, doubts less, and acts with more certainty when the time comes, watching how price behaves after the initial surge, how it rests, how it reacts to selling pressure, how it holds its ground, how it shows that the path of least resistance has truly shifted, and whether that strength remains when the easy money has already been made. When I say that price must hold above resistance to be believed, I'm not offering a theory. I'm stating a rule the market taught me with losses. Resistance is not a line drawn by a pencil. It is a memory. It represents all the traders who were once trapped, all the selling that previously stopped the advance. When price finally pushes through it, the important question isn't how fast it got there, but whether it can stay there. Have you ever noticed how quickly confidence appears the moment a level is crossed? The public believes the battle is over the instant resistance breaks. That's where they make their mistake. The real test begins after the breakout, when excitement fades and reality steps in. Sellers who missed their chance see an opportunity. Early buyers take profits. Weak hands look for reasons to exit. If price can stand firm in the face of all that, then something has truly changed. I never trusted a breakout that couldn't hold its ground. A stock that belongs higher doesn't rush back to old prices. It acts as if that old level no longer matters. That's the market telling you that supply has been absorbed. And if supply is gone, what's left to stop the advance? This is where patience separates traders. You must be willing to wait while the market proves itself. Waiting feels uncomfortable, doesn't it? It feels like missing out. But believing too soon is far more expensive than entering a little late. The market doesn't reward anticipation, it rewards confirmation. Holding above resistance is confirmation. It shows strength without noise. It shows that buyers are not emotional, but committed. When price respects the breakout level instead of collapsing back through it, you're no longer guessing. You're observing. And when you build your trades on observation rather than opinion, you stop fighting the market and start aligning yourself with the forces that actually move prices, watching how price reacts to every pullback, every pause, every attempt to push it lower, and whether that former ceiling quietly becomes a floor as time passes. When I say that most false moves happen where traders are impatient, I'm pointing to a weakness the market exploits every day. Impatience is not just a flaw of character, it's a financial liability. The market senses it the way a card sharp senses a nervous hand. Traders crowd into positions, not because the conditions are right, but because they're tired of waiting. Have you ever noticed how the urge to act grows strongest right before the market does nothing? False moves are born in that tension. Price edges toward a level, flirts with it, maybe even pokes through for a moment, and impatient traders convince themselves that this time is different. They buy because they're afraid of missing out, not because the market has proven anything. That fear creates just enough demand to push price briefly higher, but not enough to sustain it. The market doesn't punish intelligence nearly as often as it punishes hurry. When traders rush in early, they provide liquidity for stronger hands to sell into. That's how false breakouts are made. The move looks real for a moment, just long enough to trap those who needed action more than confirmation. Then price slips back, quietly at first, and suddenly the breakout everyone believed in is gone. A patient trader understands that time is part of the pattern. Real moves take time to develop. They don't need to be forced. If price is stalling, if it's hesitating, that hesitation is information. Why ignore it? Impatience causes traders to interpret uncertainty as opportunity, when it's often the opposite. I learned to respect waiting because I learned what happens when you don't. The market will always offer another chance, but it will not forgive reckless ones. Acting too soon feels productive, but it's usually just emotional movement. The trader who waits lets others reveal their intentions first. He watches who is willing to buy higher, who is willing to hold, who steps aside when the price stops cooperating. False moves thrive where traders refuse to wait for proof, where they substitute hope for evidence, where they mistake motion for direction, and where they convince themselves that being early is the same as being right, even as price hesitates, volume thins, and the market quietly prepares to show who acted out of impatience and who allowed the conditions to mature before committing their capital. When I say that real strength shows by refusing to fall back, I mean that the market reveals its intentions not in motion, but in behavior. Anyone can push a price higher for a moment. It doesn't take much enthusiasm to lift a stock through an old level. But strength is not measured by how far it goes on excitement. It's measured by how little it gives back when that excitement cools. Have you ever watched a stock break out and then felt uneasy when it immediately slipped back? A strong market doesn't need to be defended. It defends itself. After a genuine breakout, selling pressure appears as it always does. Early buyers take profits, skeptics test the move, and late sellers try one last time. If price barely budges under that weight, that's not an accident. That's demand overwhelming supply. Weak stocks collapse at the first sign of resistance. Strong ones simply pause. I learned to judge trades by how they behaved after the move, not during it. The market is most honest when it's quiet. If a stock refuses to fall back into its old range, it's telling you that the old prices are no longer acceptable. That refusal is strength, and strength doesn't need to explain itself. This is where many traders talk themselves out of good positions. They expect fireworks. They want constant motion. But the best opportunities often feel dull once they're real. Doesn't it strike you as odd that the strongest positions feel the calmest? Refusing to fall back is the market saying it has absorbed selling. That's a condition, not an opinion. It means the sellers who mattered have already acted. What remains are buyers willing to pay higher prices without panic. That kind of behavior builds trends, not headlines. The trader who understands this stops reacting to every tick. He stops fearing normal pauses. He watches how price responds to pressure, how shallow the pullbacks are, how quickly bids appear, how little urgency there is to escape the position. How the market seems comfortable at higher levels, and how that comfort persists, even when the easy profits are already gone and the crowd grows restless, waiting for something dramatic to happen, while the real strength quietly continues to assert itself without noise or apology. When I say that false breakouts expose emotional traders, I'm not criticizing them, I'm describing them. The market has a way of pulling masks off. A false breakout doesn't just fail on the chart. It reveals who was trading with discipline and who was trading with feeling. The emotional trader is easy to spot because he acts before the market finishes speaking. Have you noticed how quickly excitement replaces judgment when price nudges past a level? False breakouts thrive on emotion. They need urgency, hope, and fear to survive. Traders rush in because they don't want to be left behind. They buy because everyone else seems to be buying. But emotion is a weak foundation. It creates action without commitment. When the price hesitates, those emotional buyers are the first to doubt themselves, and doubt turns into selling. The market knows this. It pushes just far enough to attract the impatient, then it pauses. When there's no real demand underneath, price slips back. That's when the emotional trader panics. He exits not because the evidence changed, but because his feelings did. The breakout didn't fail randomly, it failed because it was built on fragile conviction. I learned that false moves are lessons written in price. They show where belief was shallow. Calm traders wait for confirmation. Emotional ones act on anticipation. That difference may look small on a chart, but it's enormous in results. Emotion always wants certainty before it exists. The market never offers that. An emotional trader mistakes movement for meaning. He sees price move and assumes direction, but movement without follow-through is noise. When price returns to the old range, it's exposing who acted without proof. The calm trader isn't surprised. He was watching behavior, not headlines. False breakouts punish those who needed the trade to work. They reward those who didn't. The emotional trader needs excitement, needs validation, needs action. The disciplined trader needs evidence. One reacts, the other observes, and the market, indifferent and exact, reveals the difference every time price moves forward without support, hesitates under pressure, and quietly slips back, leaving behind the traces of fear, hope, and haste in the very structure of the chart where emotion once looked like opportunity. When I say that patience is a trading edge, not a personality trait, I'm talking about a skill that can be learned the hard way or the expensive way. Some people think patience means doing nothing. That's not true. Patience in trading is active. It's the discipline of waiting while watching closely. Have you ever felt that pressure to act just because the market is open? The impatient trader believes opportunity disappears if he doesn't grab it immediately. The patient trader knows the market produces more chances than he can ever take. That difference shapes every decision. Patience keeps you from entering before a breakout is real. It keeps you from chasing strength that hasn't proven itself, and it keeps you from turning a small mistake into a large one. I wasn't born patient. The market taught me patience by taking my money when I ignored it. Every time I rushed, the market showed me that speed, without confirmation, was just emotion dressed up as confidence. Waiting for price to behave properly felt uncomfortable at first. But discomfort is often the price of discipline. Patience gives you clarity. When you're not in a hurry, you see things others miss. You notice where the price holds above resistance. You notice how volume behaves. You notice who is in control. Isn't it easier to read the tape when you're not desperate to be in a trade? This is why patience is an edge. Most traders won't practice it. They confuse activity with progress. But patience aligns you with the market's timing, not your own. It allows you to risk less and think more. It gives you the confidence to wait for confirmation instead of forcing an entry. The market doesn't reward the trader who needs action. It rewards the trader who waits for conditions. Patience turns trading from guessing into observation. It shifts your focus from prediction to response. And once you understand that patience is something you apply, not something you are, you stop blaming your personality and start controlling your process, watching price develop, letting ranges form, letting breakouts prove themselves, and allowing the market to invite you in rather than chasing it out of restlessness. When I say the tape always speaks before the crowd reacts, I'm reminding you that price moves first and opinions follow later. The market doesn't announce its intentions. It shows them. Long before the headlines change, long before the chatter grows loud, the tape begins to act differently. Have you ever noticed how the best moves feel almost invisible at the start? The crowd waits for permission. They want news, confirmation from others, and a reason that sounds logical. But the tape doesn't care about explanations. It reflects buying and selling as it happens, not as it's justified afterward. When demand begins to outweigh supply, price starts to behave in subtle ways. It holds where it used to fall. It rises on quiet days. It ignores bad news. Those are not accidents. Most traders miss these signals because they're listening to noise instead of watching behavior. They want certainty before acting, but by the time certainty arrives, the easy part of the move is gone. The tape already told the story, quietly and without emotion. Isn't it curious how clarity always comes after the price has already moved? Reading the tape requires patience and humility. You must accept that you won't understand everything in real time. You don't need to. You only need to observe. How does price respond to selling? Does it recover quickly? Does it refuse to break down? These reactions matter more than any opinion. The crowd reacts emotionally. The tape reacts honestly. When you learn to trust what price is doing instead of what people are saying, you stop being surprised by moves that others call sudden. They weren't sudden at all. The signs were there for those willing to watch without bias. The tape speaks in behavior, not words. It whispers before it shouts. And the trader who learns to listen early doesn't need to chase later, because he's already aligned with what the market has been quietly revealing through its actions, its pauses, its refusals to move the way everyone expects, and its subtle strength long before the crowd realizes a change has already taken place. When I say sideways action is preparation, not boredom, I'm speaking to the part of trading most people misunderstand. Traders crave movement because movement feels productive. When the market goes quiet, they assume nothing is happening. But the market is always at work, even when it appears still. Have you ever noticed how uncomfortable traders become when price stops moving? Sideways markets are where positions are built and opinions are worn down. Buyers and sellers test each other without gaining ground. Weak hands grow frustrated. Strong hands grow patient. That process is not random. It's preparation. The longer a market moves sideways, the more meaningful the move that follows tends to be. Energy doesn't disappear, it gathers. Most false breakouts come from traders who can't stand waiting through these phases. They force trades because they mistake quiet for opportunity. But sideways action filters participants. It shakes out those who need constant excitement and leaves behind those willing to wait for proof. Isn't it interesting that boredom is often the signal that something important is developing? I learned to respect these periods because they tell you who is in control. Watch how price behaves within the range. Does it hold the lower boundary easily? Does it drift upward instead of collapsing? These details matter. Sideways movement reveals balance, and balance must be resolved. The patient trader uses this time to observe, not to predict. He studies how volume changes, how price reacts to small pushes, how quickly it returns to the middle of the range. This is the market rehearsing its next act. Sideways action teaches discipline. It forces you to wait, to control your impulses, to accept that not trading is sometimes the correct position. The trader who learns to sit through these periods is the trader who's ready when the market finally chooses a direction, because he understands that preparation looks quiet, feels slow, and tests resolve long before it rewards it with motion that makes sense only in hindsight. When I say capital preservation comes before profit pursuit, I'm talking about the first rule the market enforces whether you like it or not. You can't make money if you're not in the game, and you won't stay in the game long if you treat capital casually. Every trader learns this lesson, usually after the market takes more than it gives. Have you ever noticed how profits feel exciting, but losses feel personal? The desire to make money pushes traders into trades they haven't earned. They see potential profit before they see risk. But the market doesn't reward desire. It rewards survival. Preserving capital isn't about fear, it's about respect. Respect for uncertainty. Respect for the fact that no setup works every time. When you protect your downside, you give yourself time, and time is a trader's greatest asset. I learned to think of money as inventory. You don't waste inventory. You deploy it when conditions are favorable and pull it back when they aren't. Every dollar risked must justify itself. That mindset changes how you trade. You stop swinging at every pitch. You wait for the right one. Capital preservation sharpens your judgment. When you know your downside is controlled, you think clearly. You don't panic on small pullbacks. You don't cling to bad ideas. Isn't it easier to read the market when you're not worried about survival? Many traders chase profits and stumble into losses that set them back months or years. The disciplined trader accepts small losses as part of the process. Those losses are not failures, they are protection. They keep you flexible. They keep you objective. The market is uncertain by nature. Preserving capital is how you respect that uncertainty. It allows you to participate without desperation. It keeps you emotionally neutral. And when the right opportunity appears, you're ready to act with confidence because your resources are intact, your mindset is clear, and your focus remains on protecting what you have so you can be present for what the market may offer next, rather than recovering from what it already took. When I say capital preservation comes before profit pursuit, I'm talking about the first rule the market enforces whether you like it or not. You can't make money if you're not in the game, and you won't stay in the game long if you treat capital casually. Every trader learns this lesson, usually after the market takes more than it gives. Have you ever noticed how profits feel exciting, but losses feel personal? The desire to make money pushes traders into trades they haven't earned. They see potential profit before they see risk. But the market doesn't reward desire, it rewards survival. Preserving capital isn't about fear, it's about respect. Respect for uncertainty. Respect for the fact that no setup works every time. When you protect your downside, you give yourself time, and time is a trader's greatest asset. I learned to think of money as inventory. You don't waste inventory. You deploy it when conditions are favorable and pull it back when they aren't. Every dollar risked must justify itself. That mindset changes how you trade. You stop swinging at every pitch. You wait for the right one. Capital preservation sharpens your judgment. When you know your downside is controlled, you think clearly. You don't panic on small pullbacks. You don't cling to bad ideas. Isn't it easier to read the market when you're not worried about survival? Many traders chase profits and stumble into losses that set them back months or years. The disciplined trader accepts small losses as part of the process. Those losses are not failures, they are protection. They keep you flexible. They keep you objective. The market is uncertain by nature. Preserving capital is how you respect that uncertainty. It allows you to participate without desperation. It keeps you emotionally neutral. And when the right opportunity appears, you're ready to act with confidence because your resources are intact, your mindset is clear, and your focus remains on protecting what you have so you can be present for what the market may offer next, rather than recovering from what it already took. When I say breakouts emerge when opinions are exhausted, I'm talking about a condition the market reaches only after it has worn everyone down. Strong moves don't begin when traders are confident. They begin when confidence has been replaced by boredom, frustration, and disagreement. By the time a real breakout forms, most people have already made up their minds and stopped paying attention. Have you noticed how quiet the market feels right before something important happens? Opinions build during ranges. Bulls argue with bears. Analysts draw lines and revise forecasts. Predictions multiply, but price goes nowhere. That back and forth drains energy from both sides. Traders who were once passionate grow tired. They exit positions, stop watching closely, or decide the market isn't worth the effort. That exhaustion is not weakness in the market, it's preparation. When opinions are exhausted, resistance loses its defenders. Sellers who believed strongly have already sold. Buyers who were eager have already acted. What remains is balance, and balance doesn't last forever. When price finally moves out of that condition, it doesn't meet much opposition. There's no one left with enough conviction to stop it. This is why the best breakouts often surprise people. They don't come after bold predictions. They come after indifference. Isn't it interesting how the market waits until most traders stop caring before it makes its move? I learned to pay attention to sentiment, not for what people said, but for how tired they sounded. When arguments repeat and nothing changes, the market is close to resolution. Price begins to creep. Volume shifts quietly. Small moves stop being reversed. These are signs that opinions no longer matter as much as positioning. A breakout born from exhausted opinion has room to travel. It's not fighting a crowd. It's moving through empty space. The trader who understands this doesn't look for excitement. He looks for silence. He watches when nobody is certain, when forecasts lose conviction, when traders stop defending their views with urgency, because that's often when the market has finished listening to opinions and is ready to act on its own terms, moving not because everyone agrees, but because there's no longer enough disagreement left to hold it in place. A real breakout is not born from excitement. It comes from patience. The stock trades in a narrow range, day after day, wearing out both bulls and bears. Volume dries up, opinions pile on top of each other, and nothing seems to happen. Most traders grow restless there. They want action. But isn't that restlessness exactly what costs them money? When the breakout comes, it doesn't ask for permission. Price moves beyond the old boundary and holds there. Not for a moment, not for a tick, but with authority. That's the part most people miss. They chase the first push, but I wait to see if the market agrees with itself. Does it stay up? Does it refuse to fall back? The tape tells you if you're willing to listen. You see, the market never rewards hope. It rewards being right and sitting tight. A real breakout shows itself by refusing to go back where it came from. If price slips right back into the old range, what is it telling you? That the path of least resistance hasn't changed. Why argue with that? Money management is what keeps you in the game long enough to recognize these moments. I never risked much on an idea until the market proved me right. Small losses are tuition. Big losses are arrogance. Isn't it better to wait for confirmation than to brag about being early? Your mindset matters more than your indicators. You must be calm enough to wait and strong enough to act when the moment arrives. Breakouts don't come every day, and they don't come on command. They come when supply is exhausted and demand finally takes control. And when you see that kind of move forming, when price steps out and holds its ground, that's when you stop talking, stop guessing, and start listening to what the market is already saying.